Hey guys, and welcome to CT Guides. My name is Theo, also known as Tao Cruz, and today we'll be doing a lesson on when to hedge. And hedging is basically a strategy in trading that allows you to manage risk and protect against large price movements. And there's various situations in where you might use a hedge, and we're going to go over a few of those today. So a common situation in which a hedge is used is prior to events which are highly correlated with volatility. And during periods of heightened volatility or uncertainty, traders may hedge their positions to limit potential losses from large and unexpected price swings. And that's particularly relevant when there's significant upcoming events or other factors that could impact the overall market stability. For example, a trader holding a significant long position in Bitcoin prior to an event like Bitcoin halving may hedge with a short to protect against a potential sell-off once the event takes place, kind of following a buy the rumor and then sell the news mantra essentially. So by taking an offsetting position, traders can reduce their overall risk and potentially enhance their returns. And that's because there's profit to be made in whichever direction the token's price goes. So if there's a minor correction, you can close that short for a profit. And should the price bounce upwards and that bullish trend continue, you can keep on holding that primary long position until it reaches your final price target. Another situation in which you may want to hedge is when a token that you're holding becomes overbought or oversold. So when a market or a token in this situation becomes overbought, meaning prices have risen too far too fast, or oversold, conversely, prices have fallen too far too fast, traders may hedge to protect against a potential reversal or correction. And hedging in such situations can help mitigate losses if the market experiences a sudden reversal in the main trend. For example, if a trader has a long position in a token that is overbought, they can open up a short on the same token to protect their profits in case of a market correction. Conversely, if a trader is short on a token that is oversold, they can open a long to protect their profits in case of the token's recovery in price. I'll touch on the long and short-term aspects of hedging now. So traders holding long-term positions may hedge against short-term price volatility to protect unrealized gains or minimize potential losses. And that's especially relevant for investors with large positions or with those with long investment time horizons who want to safeguard their capital. So an example of this would be you bought a large position of Solana for your long-term portfolio when it traded around $9 and it now trades at $180. And you intend on holding it for 10 plus years for a final price target of $500. However, you don't want to lose out on the 100% gains you have right now going from 90 to 180. So you open up a Solana short so you can profit on a potential downswing and offset losses in your long-term Solana long. And I'll wrap up here with a summary of all the topics we spoke to today. So events cause volatility, they're directly correlated, and because of that short-term volatility, we may open up a hedge. And what that hedge provides us is reduction in our risk, and essentially that's going to allow us to hold our primary position that we invest a lot of money in, and kind of have that peace of mind that even if there is a correction and large price swing against us, that we're gonna be protected. Now, if you're long on a position and it becomes extremely overbought, but you still want to kind of continue holding it, for long-term growth, you may consider opening up a short, kind of up there to hedge. Should the price correct, you're going to be able to make a profit there, and it's not going to affect the long-term thesis. On the other hand of things, if you're short on a token and it becomes greatly oversold, perhaps you might want to open up a long to hedge there. Should the token's price recover, there'd be kind of like a dead cat bounce. You're going to be able to close that long out up there for a profit, and say that bearish trend, that downwards trend continues. You're on easy street, because now you have that extra cash created from that long hedge, and you're going to be able to continue holding that token short until it reaches your final price target. Now, if you're a long-term investor, you're going to be holding tokens on spot, and you're going to be holding it for growth, for that big price appreciation over a long period of time. However, in the short term, there's going to be a lot of volatility, and especially in the crypto markets, there is no shortage of that. So, say you have a big price swing up your way, but it's still pretty far away from your price target. You don't want to close the position out. Perhaps you open up, a hedge up there, should the price kind of retract a little bit, so that you won't come away with nothing, right? That short's going to be able to provide some profit to you, while at the same time, you're going to be able to keep your long-term investment thesis intact, and you're not going to sell, prematurely before you hit that price target. Well, that's going to do for today's lesson, guys. I hope you enjoyed it. And as always, if you have any questions, feel free to shoot me a message on Discord. My username is Tao Cruz. You can always leave a comment below too, and I'll get back to you that way.